Welcome. Today is Wednesday, January 31st. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and founder of Alpha Insights. And this is your Daily Five. Today, I just really wanted to start out with a quick reminder that our February issue of Huge Insights, The Big Picture, our investment newsletter, will be coming out on Saturday, February 3rd. This, just for those of you who do not follow our work yet, we do publish a monthly investment newsletter. It's available on Substack. It's free to subscribe and have it delivered directly into your email. We usually publish the first Saturday of each month following the NFP report. The newsletter is affectionately titled Huge Insights, The Big Picture. Within the newsletter, we basically cover a variety of macro factors and issues affecting the economy and the markets from a big picture perspective. But we get a lot of inquiries from our readers who want more. And so for that reason, we do have an option to upgrade to paid for as little as $12.50 a month. That includes a much more detailed look at our market forecast and positioning recommendations. Paid subscribers also receive our weekly Alpha Insights Idea Generator Lab publication. This is an institutional report that goes out to our institutional strategy subscribers. Typically, it details our top actionable trade idea each week and also provides some updated market commentary that goes out after the close every Wednesday. In addition, we also provide some privileged access to quarterly video content that we wouldn't otherwise put out to the general public, typically presentations that we make at institutional conferences, and occasionally we'll send out an interim bulletin. This is a big change of thinking that comes about in between our normal publication schedule. If in fact there is something to say, we'll go out with an interim bulletin and you would be included on that. So without further ado, let's jump right into today's presentation. One of the things that I think is important to understand is that the market, the herd, if you will, is betting very heavily on the fact that the Fed looks like they're going to begin a rate cutting cycle, a very aggressive rate cutting cycle, if the market is to be believed, in the coming months. Some have posited that this could begin at the March meeting. Others are now saying the May meeting. Most recently, I've heard others out saying no sooner than June. But the market's currently pricing in about 625 basis point rate cuts before year end. Now, if we were to take a look at the quarterly dot plot, the Fed governors themselves on average are suggesting about 3 cuts this year, not to begin until the second half of the year. And so, our thinking at this point is that, if we do get into a situation where the Fed begins aggressively cutting rates in the first half of the year, it's not going to be good news for the market. The problem is, the herd believes that it will be good news. They think that this is a bullish setup for the market. History says otherwise. If we look back since 1957, no fewer than 11 of the past 14 rate cutting cycles have actually coincided with a bear market and a recession. Indeed, over just the last 3 decades of our career, there have been 4 rate cutting cycles, 3 of which have led to rather savage bear markets and recessions. And so, the one instance in that 4 that did not actually result in a recession or a major bear market can be distinguished by 2 key characteristics. The first one was relatively low valuations. The second being relatively high interest rates. So what we have is we've overlaid on the chart to the left an indication of the Shiller's CAPE ratio. And if we take a look back in 1995, the Shiller CAPE ratio was about 20 times. Now, the Shiller CAPE ratio is different than the PE ratio in that it adjusts the PE ratio for both inflation and it normalizes margins, okay? For those who are not attuned to accounting that basically means that they're leveling the playing field, if you will. And so, when we hear 20 times, we have to think about it relative to where we are today. And so 20 times versus, say, 44 times at the peak in 2000 is a relatively low valuation. Today, interest rates are about 4% on the 10-year. Back then, they were about 8% on the 10-year. And so there was a lot of room for rates to decline, whereas today, not so much. So during this period where we saw I guess a soft landing, if you will, I would say it was more of a no landing. The Fed cut interest rates for reasons different than being concerned about the economy. They were cutting rates basically into the year 2000 crisis, as well as other crises. There was the 1997 currency collapse over in Southeast Asia with the Thai baht, for example. We also had the long-term capital management crisis and the Russian debt crisis. So all of those things led to a cutting of rates into kind of this period here right ahead of 2000. And for that reason, I think we had a big push up in the market. But following that point, the Fed actually engaged in an aggressive rate cutting move. And in that period of time, which was almost 2 years, we saw about a 54% collapse in the S&P 500. Again, we saw rates move up to higher levels, and then the Fed engaged in an aggressive rate cutting move from late 2007 into early 2009. And again, we saw about a 49% collapse in the S&P 500. Again, from relatively high valuations, 27 times here, 44 times there, versus say 20 down there. We had a long period where the Fed held rates near zero, if you will. But the next time the Fed raised rates, we ran into a little trouble. You can see that the market got a little choppy in here and peaked around 31 times on the Shiller-Cape ratio. Just as the Fed began cutting rates, we saw the market collapse here 38%. Now, a lot of people would say, well, that was because of the COVID crisis. We would say that the market was set up for decline regardless. And so, we'll see how it plays out in the current realm of possibilities. We've seen a very rapid rate increase over about 22 months. It's actually the fastest and steepest rate increase in over 40 years. We increased rates by about 525 basis points. Now, valuations got pretty lofty up at around 38 times here. And we did get about a 27% decline in the S&P 500, but subsequently we've rallied to new all-time highs. Now, earnings have recovered somewhat as well, and so the PE ratio, the Shiller-Cape ratio, is a little lower than it was back at the prior peak in 2022 at around 33 times. But if we do get into a situation where the Fed begins to aggressively cut rates, we think it's highly probable that will coincide with a recession. In fact, one of the things that we think is interesting is that soft landing narratives, like the one we hear every time we turn on the TV or open a newspaper, are often very prevalent preceding recessions. In fact, according to Bloomberg, the number of news articles mentioning a soft landing today are nearly double that which preceded the 2008 recession back in this time frame. Actually, it's about equal to what preceded the 2001 recession. So it's not uncommon to hear news media pundits and analysts and strategists talk about a soft landing. It tends to be what precedes a recession. Let's take a look at chart number 2. Bank credit currently points to a recession. Well, let's dig into this a little bit. We've got 2 different data series overlaid on this chart. In blue, we're showing the latest quarterly senior loan officer opinion survey. This is the SLOOS report that people refer to occasionally. And after peaking up here around 50%, we now see that around 1/3, or a little over 1/3 actually, continue to see a tightening of credit and lending standards in the fourth quarter. Now, if we take a look back at past recessions, usually that peaks around 50% and starts to decline ahead of or into a recession. Again, here we've peaked around 60% here. declining into a recession. Here we peaked much higher, around 80%, declining into a recession. Here, the recession actually ended when we got up to around that 70% level. But 50% is typically, if we go way back into the data series, it's usually kind of the make or break line. So we got above 50%. We're now turning down. Very, very consistent with the condition that precedes a recession. Meanwhile, if we take a look at year over year commercial and industrial loan growth, this is the red line, that's actually turned negative. We're at negative 1.3% right now. That's the month of December reading. It's the first time since back in 2008 that we've seen new loan growth decline, actually contract. And so, a tightening of lending standards and a contraction in new loans has historically coincided literally with every economic recession on record in the US. And we're going back here to the early 80s. This is a 40-year look back, and we can see in gray a recession, a recession, a recession, a recession. Will we get a recession? I think the odds are very, very high that we will. If we look back over the past 50 years, new loan growth has never, ever turned negative without being followed by or coinciding with the recession. So, we take a look at kind of the broader picture, not just commercial and industrial loans, but think about what's going on in the consumer world right now. Consumer loan delinquencies are now above levels reached back during the great financial crisis. In fact, 21% of all home mortgages are currently delinquent by 60 days or more. That's an enormous percentage of mortgages. Credit card balances now exceed $1 trillion today, and interest rates on the credit card balance now average more than 25% APR. If you do the math on this, it just ain't pretty. So we would be very, very concerned. We think this is a leading indicator of what is to come, and we think a recession is to come. Let's look at chart number 3. Investor sentiment is now diverging. Investor sentiment remains pretty bullish across most groups. CTAs, vol control funds, risk parity funds, these guys currently hold record net long commitments to US stock index futures. That is potential stock that can be sold. These are the weakest hands in the market. Their conviction is driven by the trend. When the trend bends, so does their conviction. And I think this is a potential avalanche of selling that could come. But if we take a look at, professional money managers, this is the National Association of Active Investment Managers. This survey name actually looks at professional money managers and professional asset allocators and surveys them every couple weeks. And this is a moving average of that survey. And what we're seeing right now is that current equity exposure remains quite elevated at about 84.5%. Now, it's not as high as it was looking back in late December. It got to 102%, actually exceeding the peak from July. But what we're seeing here is that we've got a bit of a divergence as prices have made a new high here. Bullish sentiment is actually making a lower high. It's still very bullish, but it's not as excessive. And that potentially could be a problem. If we look at the individual investor survey, this is the American Association of Individual Investors, the AAII survey. This survey suggests that individual investors continue to hold about 66.4% of their assets in stocks and stock mutual funds. But the spread between the bulls, which are around 39.3%, and the bears, 26.1%, is now 13.2%. That's a healthy, positive figure. And this is a traditionally notorious bearish cohort of investors. This is, a bunch of curmudgeons out there who, are not always very, very bullish. And so when we get a positive reading here, it's actually pretty significant. The most recent positive extreme occurred at 32% in December for 2 consecutive weeks. That actually, again, exceeded the July peak, which got up to around just shy of 30%. So again, what we're seeing here is, a lower level of bullish sentiment or lower peaks as the market's making new highs. See, the market made a new high, pulled back, made a new high, but sentiment made a lower high. made a new high, sentiment's making a lower high here. And so this pullback, this negative divergence between price and sentiment, well, it actually has some negative connotations. While, we're still kind of in an all-in sort of phase between virtually every investor cohort out there. This latest reading indicates an element of doubt is beginning to surface among investors, and these divergences tend to precede major trend changes in the market. And so we need to be alert to the fact that the market could potentially be very near a turning point. And when we're turning from all-time record highs and these sorts of extremes in sentiment, it's probably not going to be a minor pullback. We're expecting something of greater significance here. Let's take a look at chart number 4. Insider selling is rampant. The one group of investors out there that appears to be far less enthusiastic about what the future may hold is corporate insiders. These are C-suite executives and directors of publicly traded companies who have access to material non-public information about their respective businesses. They are now selling shares more aggressively than at any point in the last 12 months. And indeed, with over 225 million shares sold last week versus 3.5 million shares bought, the sell-buy insider transaction ratio is now about 64-1. But importantly, here we are at 64-1. 2 weeks ago on January 12th, that insider transaction sell-buy ratio reached an all-time record high of 145-1. All-time, never seen before in the history. Not even close, actually. This is an incredible extreme of insider selling. And, if we take a look at historically how this measure should be gauged, readings under 12-1 are considered to be bullish. Anything under this line is considered to be bullish. Anything over this line, which is 20-1, is considered to be bearish. We're more than 3 times above that line. And, honestly, at this point, we got to, something in the neighborhood of 10 times, it was much, much higher than actually about 15 times, but much, much higher than, 7.5 times than what we would typically expect. And so, at the end of the day, I think we have to consider the amount of insider selling here as a signal, as a warning sign of what may be to come. Let's take a look at chart number 5. Negative momentum divergences. Despite this steady climb to new all-time highs that we've seen in the major averages this year, momentum has been waning. We're looking at the 13-week deviation from the 13-week moving average, okay? So basically, what is the deviation above or below this red line, which is the 13-week trend of momentum, okay? And basically, what we would hope to see is that as price makes a new high, momentum would go on to make a new high. As we've seen from this point here, every time price kind of started moving higher and higher, we'd start to see momentum following through. We got this initial foray or this breakout here. Momentum confirmed it back in late December, right? But what we've seen recently as the markets moved to new highs is that momentum has failed to confirm that, okay? And negative momentum divergences are actually evident at 3 degrees of trend right now: daily, weekly, and monthly. And what we're showing right now is the weekly momentum divergence. And this intermediate term degree of trend is actually very important because it captures most investors' time horizons. You got swing traders, you got end of quarter fund managers, you've got hedge fund managers and CTAs that kind of have the whole year to get their act together. But intermediate term really kind of covers that whole period from kind of, a month to 1 year, if you will. And as indicated by the vertical dotted lines here that we're showing, prior highs in price that were unconfirmed by coincident new highs in momentum, looking back here to 2020, new high in price, unconfirmed by momentum. Here in 2022, a new high in price, unconfirmed by momentum. Back in July, a new high in price, unconfirmed by momentum. And most recently, a new high in price here in January, as of yesterday, unconfirmed by momentum. So, what we've seen really is that when we see non-confirmations or negative divergences in momentum, they have been followed by very vicious sell-offs ranging from 11% down to 35%, just looking back over the last 5 years. But the same condition can be found in the historical record preceding all past severe market declines. Here's the thing. When daily, weekly, and monthly momentum divergences are all in synchronicity, it is especially telling. And investors who ignore this warning, I think they do so at their own peril. Let's take a look at one last bonus chart here. We've been putting out our Elliott wave count and analysis on the S&P 500 for the past year. And honestly, it's been tough. We've had it wrong from time to time. We looked like we had it right here, and the pullback just halted, and we got another rally to a new high. And then we thought, well, that was the high, and we got a nice vicious sell-off, and those who shorted the market made some good money here. And we actually had a good call. We thought, sure, we're going to see a rebound here, and that rebound is going to carry back up into this zone right here. Well, it just kept going, and we missed this whole big move. We called the top at about July 27th. In fact, I think we published a StockCharts video on July 27th calling for a top in the market. And we got a vicious sell-off of 11% over the subsequent 3 months. And back on October 27th, we said we probably found an interim low here, and we'd expect at least a 50% retracement. And of course, we got that 50% retracement right in here, but then the market broke out and kept going, and we missed this entire move right into this zone right here. From about this zone, we've thought, okay, now I think I know what's going on. I think this is actually a fifth wave. The breakout above the prior 48.18 high gave us a pretty good clue that this was no longer a bear market rally, that we were in a new bull market advance. But where in the trend are we? Is this a new bull market that's going to carry, to 5,000 or 6,000? Or is it the end of a bull market? We think it's the end of a bull market. We think that this is cycle wave 5. This is actually, we're going to be ending Supercycle wave 3. And so as we find, the terminal point of this last move up, which we're counting as 5 waves, a minor degree of trend, 1, 2, 3, 4, and then a 1, 2, 3, 4 minute wave. We think one more move up possibly to end minor wave 5, of intermediate wave 5, of primary wave 5, of cycle wave 5, of supercycle wave 3. We think this is it. And certainly, with the price action that we're seeing today, it's possible that we've already found that low. It's possible that this is a 1, 2, 3, 4, 5, and that we topped just shy of our target of 49.40 at just 49.29, I think was the high. And so let's think about this. Why would 49.40 be a reasonable target? Well, if this is primary wave 5, if we hit 49.40, that would be exactly 2.618 times primary wave 1, which was the initial advance off the 2009 low. We think that's a pretty good target. It also comes right into line with this, parallel trend channel that connects the October 22 low with the October 23 low, and then taking the parallel line off the July high, it would get us to a January or early February high here at around 49.40, give or take. That's a possibility. What's also a possibility is that we've topped out here already, and that we've seen the terminal move to the upside, terminating cycle wave 5 and supercycle wave 3. And what follows supercycle wave 3? Well, that would be supercycle wave 4 down. Supercycle wave 4 will be at least a 3-wave corrective waveform that corrects a 90-year advance that began back in 1932 and ended potentially yesterday. And if that's the case, we should expect this decline to be epic in nature and absolutely severe in its initial foray to the downside. We've marked some open chart gaps here beginning at about 44.11 that we think are pretty, likely magnets for price. Once we break down below this 48.02 line, the prior high that we saw here, and take out this trend line connecting the bottom of primary wave 4 to this intermediate move up. And what we're really thinking here is a breakout below that 48.02 level should immediately carry prices down to 44.11, 43.17, 42.37, 41.17. And if we take out 41.17, we think there's a lot of air between this point and the next low down here around 37.5 or 35.83, a gap that dates all the way back to October of 2022. A break below that would open the gateway to new bear market lows, of course, and exactly what we think will follow the end of Supercycle Wave 3. In our newsletter this month, which will go out on February 3rd, we will detail all of this and add a great deal more commentary and give you some real narrative and some solid reasons why we should expect this and how we're positioning for it. So if you'd like to get a better sense of where we think we're going with this thing, sign up to receive the newsletter. And if you're already signed up, it'll be in your in your email box on Saturday morning, probably around 6 a.m. Central Time. If you're not a paid subscriber, unfortunately, you're not going to get a look at what we're really thinking. You'll get a tertiary look at what we think is driving this, but to really get the full Monty of what we think is going on in the market, you should consider stepping up and getting a paid subscription. It's only $12.50 a month if you buy the annual subscription. We think that this is a pretty good value, especially given all the other, incremental stuff that you'll get, reports, etc., videos. And so with that, I want to just thank you all for your time today and wish you the best of luck trading. If you do want to follow up with us, you can reach out via our website at www.jwhinvestment.com. Follow us on Twitter at alpha_insights, or go right to Substack at hugeinsights.substack.com and sign up to get our newsletter. Again, thanks a lot for watching.